Good afternoon, ladies and gentlemen, and welcome to the Arrow Exploration Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and you'll receive an email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and I'm sure the company will be grateful for your response. And I'd now like to hand over to Marshall Abbott, CEO from Arrow Exploration. Good morning to you, sir.
Thank you. Thank you for this opportunity, and thank you for your time. I'm going to walk you through a very strong value proposition on one of the only producing onshore oil companies in Latin America that's listed on the AIM exchange. So just getting through the disclaimer, here's a snapshot of the company. So from an investment overview perspective, we have an opportunity-rich asset base across two basins in Colombia, two of the more prolific oil-producing basins in Colombia, where oil production historically has been ongoing for about 80 years. Of course, we're committed to ESG best practices and investing in our communities. We have always taken that stance and operate to the highest standard. We have done that in every jurisdiction we've been busy in. Our 2020 year-end reserves of 7 million BOE are very solid. I'll walk you through the reserve picture in a minute. We have an unrisked prospective resource report at a field that we call Carrizales Norte of 1.3 million barrels net to our share. Production today is actually closer to 580 BOE, on our way to 3,000 barrels a day within 18 months of our financing, which closed last week. We have a seasoned executive team and a board that is diverse, transparent, and independent. And I will take you through the compelling valuation metrics that exist in our company now. The key catalysts are a six-fold increase in production following planned drilling program over the next 18 months. That's focused on expanding production at a pool that we call Rio Craveste. I will refer to that as RCE, and then adding production from Carrizales Norte. We also have a very prolific Canadian asset that we're going to bring on stream within the next few weeks. All of this then pivoting to a lower risk exploration program with significant well inventory on lands that we currently hold based on 3D seismic. We completed our financing 8.8 million pounds, 12 million US, via placing an admission to AIM. The use of proceeds is to support the investment program in Colombia and on a very interesting asset we have in Canada. A corporate snapshot, our market cap today is just over 30 million, our enterprise value 21 million. We have 286 million shares outstanding. We're north of 553 barrels a day, 7 million barrels of 2P reserves, 10 million barrels of 3P reserves. Our EV per flowing barrel is about $17,000 per flowing barrel, which is very cheap. EV per barrel in the ground reserves of $3.04 is very cheap. And currently we're sitting on 12.3 million of cash. So from a multiple catalyst standpoint, as I mentioned, we have a Canadian asset that we inherited that has two existing wells on it that are very prolific gas producers. And gas prices in Canada are currently very robust, approaching $6 per thousand cubic feet. We call this the West Pepper well. I will talk a little more in detail towards the end of the presentation. Focusing on the Colombia asset, the first thing we're going to do in Q1 22 is drill a development well at RCE2. We'll follow that back to back with the well at RCE3. We'll then flip-flop over to Carrizales Norte, as we will have expanded our drilling pad there and drill Carrizales Norte. And then, as you can see, bouncing back and forth between RCE and Carrizales. And then towards the end of this year, early next year, we're going to shoot a rather broad 3D seismic survey. A 3D seismic is the key to increasing chances of success over 75%. So these are providing opportunity for material growth and share price re-rating. Our production profile shown thus, we're currently in excess of 550 barrels a day. The light blue shade is bringing on the Montney asset at about 1,000 BOE. These are very strong gas wells. We're tying in what we call the West Pepper well. Construction will only take about 10 days, starting within the next couple of days, and that will be on stream the first week of December. So we expect a very large jump in production and cash flow through the month of December and onward. And then you can see stair-stepping between the two assets of RCE and Carrizales Norte, taking into account 15% declines on that production as well. We're forecasting only 360 barrels a day net out of those wells. We operate at a 50% working interest. These wells can be much more prolific, upwards of 1,000 to 2,000 barrels a day. So we're very conservative on our modeling and our forecast. As mentioned, 3,000 barrels a day within 18 months of admission to AIM. We're have the growth engine primarily from Carrizales Norte and RCE, and the additional production from our Montney well in Canada, pivoting to the 3D seismic program in the Llanos Basin. From an ESG perspective, we've always been friends of the environment. We have constant communication with the environmental regulator in Colombia. As an example, in our oil production in the Llanos Basin, we produce no solution gas. There is no gas entrained in the oil. That oil comes out basically as dead oil. It's very light. It comes out fast. And so our GHGs are held to a minimum because there is no gas to flare. We involve the community in everything from security to first aid to road maintenance. That's mandated by the energy regulator in Colombia. Stakeholder engagement, of course, is important to us. With the environmental regulator, the government of Colombia, the energy regulator in country. Our people, of course, are our best asset, certainly down in Colombia. We take care of our guys. We have an ongoing COVID testing program. We have vaccinated all our employees, and they are our strongest resource. We've never had an injury, accident, or any kind of incident that affected our people adversely. And then from a leadership and governance standpoint, we'll walk you through the leadership and the governance on the board, as I mentioned, is diverse, independent, and transparent. Go ahead, Gage.
I believe we're having some trouble hearing Gage.
Yeah, I was going to say, Gage, you're on. You would appear to be on mute on your iPhone, on your headset, sir. We're not picking you up. If I could just ask you to hand over to another Marshall, and I'll sort the connection issue out now.
I'll just carry on.
Thank you, sir.
So, as mentioned, we have a seasoned management team. Gage Jol is our executive chairman, 30 years of capital markets experience in the energy space, former head of energy investment banking at Moody Research Capital, Mackey Research Capital. He's an MBA, petroleum engineer, and a CFA. I'm Marshall Abbott. I'm pushing 40 years of leadership building and accretively selling successful oil and gas companies in multiple jurisdictions worldwide. I was trained at Texaco and then moved to smaller companies, starting my own companies. I've started and sold 8 companies profitably, some of them in excess of 200% rate of return. I've got an honors geology degree from the University of Alberta. My family's been in the oil business since 1949. Joe McFarland has been my partner for the last 15 years, Chief Financial Officer. He grew up in the oil and gas industry and is well respected by not only our regulator, but many of our shareholders and primary institutions. Bob Petrick is our operations manager in Colombia. He's a 40-year guy. He's got the hand on the pulse of Colombian oil and gas. Phil Miller is our Senior Vice President of Exploration. Phil has been around. He's one of the 200 people worldwide that really get it in international oil exploration outside of the major companies. And Max Sattel has 17 years of experience and is our investor relations corporate development individual. So a very solid management team, well-heeled, experienced. And from a board perspective, there's myself and Gage. We then have Maria Chirash, who is domiciled in London, MBA, a fellow of the ACCA. She was in charge of the British gas acquisition by Shell. She's well-heeled in oil and gas operations. Grant Carney, another independent board member, has 35 years of oil and gas experience. He ran a $1.2 billion equity fund based out of Denver. He's been a very solid cornerstone shareholder of mine for the last 2 deals that I've done. He's got an honors geology degree as well. We have 2 individuals that represent Canacol's interest, non-executive directors. Anthony Zaidi is the general counsel of Canacol Energy, the largest independent gas producer onshore Colombia, and Ravi Sharma is the chief operating officer of Canacol. Canacol owns 19.9% of our stock, and they are fabulous partners. We are actually a spinoff of their oil assets that was done in 2018. So we have an excellent relationship with Canacol. They have gravitas within the Colombian oil and gas industry and are well respected by all stakeholders. So this management team arrived just as COVID was peaking. We were brought on board in April 2020 to turn Arrow around. It was in distress at that time. We, of course, started working for free, and we took prompt action to secure the future of the company. We sold an asset called the Llanos 23 block to a Carlyle interest for $12 million. We reduced staffing levels, canceled unfavorable contacts. We had about $12 million in debt that we knocked down to zero expeditiously. These actions have created substantial value for shareholders, and our share price increased from 2.5 cents to recently as high as 16 cents. So it's been an enjoyable ride. We intend to take this value proposition much higher as we start to get active in the field and execute on our development plan. So here's a snapshot of Colombian oil and gas operations that involve Arrow exploration. The map on the right is the Colombian regional map showing the basins that we have assets in. We are going to focus today on the Llanos Basin and the Middle Magdalena Basin. The Llanos Basin, we have a 100 square mile concession that we call Tapir. We're currently producing about 140 barrels a day at Tapir. That is where we're going to be drilling RCE and Carrizales Norte. That's going to take our production through 3,000 barrels a day in 18 months. Also Pardo, number 2 in the Middle Magdalena Basin. We are 100% working interest, currently producing about 130 barrels a day. We have applied to the regulator to expand that block to encompass an oil accumulation that we actually are producing from as we speak. And that is a bit of a free option. We're forecasting no production increase out of Oso Pardo, but I'll show you that in detail. We also have a heavy oil asset that we're a 10% working interest owner that's doing about 190 barrels a day today. That's operated by a Chinese concern called Emerald Energy, a subsidiary of Sinochem. We don't control our destiny there. We are going to relinquish that back to Emerald Energy. And then focusing on the Canadian production, we have about 90 BOE of gas coming out of non-operated production in Canada. And then our Canadian Pepper gas well that should be on within the next few weeks. We're 100% working interest. and that's going to be coming on at about 1,000 BOE. So we have very near-term production adds. We enjoy Brent pricing, less a small differential in Colombia. Our oil is very light and sweet, and it's used as a diluent in the pipeline, taking it to 2 major refineries on the Caribbean coast. And we get paid as soon as we deliver to the pipeline. We have good access to that infrastructure. It's very close to our production operations. Oil is a big chunk of Colombia's GDP, upwards of 30%. Colombia, as a country, peaked at 1 million barrels a day in 2012. Today, they're at about 750,000 barrels a day. And the government has mandated they want to get back to 1 million barrels a day. They've incentivized industry accordingly. The royalty rates that we enjoy are between 8 and 12%, which is in the top decile of international fiscal regimes. There has been political unrest in Colombia, primarily due to COVID angst and the introduction of a tax reform bill by the government. There were 2 weeks of protests in most of the urban centers. Through those 2 weeks of protest, we continued to produce and cash flow without skipping a beat. Of course, that has entirely died down. The country's back to business. They are upwards of 70% vaccinated. The tax reform bill was modified to be much more acceptable. So they do respond, and it is a very pro-business environment to be working in from an oil and gas perspective. Here's our 2020 year-end reserve outlook. This is based on December 31st price deck. As you can see in the chart in upper left, those are very conservative pricing values. I'll show you an updated slide in a second showing updated Brent pricing. 7 million barrels of 2P reserves. A good chunk of that is the heavy oil asset that we're going to be disposing of. $34 million of 2P reserves at 10%. And the next slide shows you our reserve picture, removing the Ombu asset. So 3 million barrels of 2P reserves, 5 million barrels of 3P reserves, PV10 at $26 million. The Brent pricing price deck in the upper left-hand corner is much more realistic at $65. We've done our budget at flat 65 Brent, and everything that we're doing is very economic and accretive. In fact, this disposition back to the Chinese concern will result in higher corporate netbacks per BOE, and it is an accretive disposition to the company. So from an overview of the Tapir block, I'll walk you through with some maps in detail in a second, but there are excellent subsurface fundamentals that exist in the Llanos and Middle Magdalena basins. There are multiple prospects that have been identified with additional follow-up wells based on success. We have high-quality reservoir targets with excellent porosity and permeability. The oil comes out fast. Type wells in the neighborhood that we're active in can have initial production rates of between 1,300 and 2,000 barrels a day. On our way down to 10,000 feet on the drilling phase, we typically encounter 3 oil-bearing zones per wellbore. Historically, the regulator has allowed only 1 zone to be produced, but they're opening now the opportunity to complete multiple zones in an existing wellbore, which makes them much more economic, of course. And we have multiple opportunities with our existing 3D seismic coverage. I'll walk you through that in a moment. And we have potential for 4 to 5 development wells at each of RCE and Carrizales Norte. And then as we proceed through the development low-risk drilling phase, we will pivot to our low-risk exploration phase, where we have numerous leads currently identified on 2D seismic data that we will focus in with a high-resolution 3D seismic survey. And when you have 3D in the Llanos Basin on these tectonic structures up against faults, your chance of success goes up upwards of 75 to 90%. So 3D seismic is the key. Here's a snapshot of block holdings in the Llanos Basin. You can see our block at the center of this map. We have a 100 square mile concession in the heart of oil and gas production in the Llanos Basin. Canadian companies in this basin collectively produce about 250,000 barrels a day. There's a strong Canadian presence. As you can see, the lineation of some of these ownership blocks is these trends to the north-northeast. These are tracking fault trends that exist on these blocks. So there's oil production out of these single fault trends. Our block, as you can see, is at right angles to that prevailing trend. And we actually intersect 6 fault blocks, one of which we're focusing on for production. And as we get our 3D seismic survey shot, we're going to have much better resolution on these other 5 faults that exist on our block. The photographs show the terrain that we're active in. These are large agricultural areas, cattle ranching, palm oil plantations, so very easy access year-round. And we also have production facilities in place on our Llanos Tapir block. So we can drill these wells inside of 2 weeks, production test them for another 2 weeks, and they're on stream immediately on the Tapir block. So here's a cartoon map of our block outlined in red. You can see kind of bottom left our RCE1 well, currently producing about 300 barrels a day. It has 3P reserves of 4 million barrels. And then just to the left of that, the purple blob is Carrizales Norte. I'll show you that in much more detail in a second. But the point of this slide is to show you that we are surrounded by oil production that today has produced cumulatively about 38 million barrels. We like drilling for oil where oil already exists. One of the more noteworthy fields is the Carrizales field, just south of our block boundary. It's produced close to 9 million barrels to date. It peaked at 7,500 barrels a day. And we are an extension of that pool just to the north. I'll show you that map in more detail. The blue blobs that you see are leads that we have identified with 2D seismic data and where we're going to focus our 3D seismic shoot as we progress through to the fourth quarter of 2022. So in developing the Tapir block, you can see our forecast production on the right, taking into account 15% declines and showing that we're forecasting only 360 barrels a day per well, which is a very conservative forecast that we've utilized for budgeting purposes. On the map on the bottom left, you can see the thin gray lines are our 2D seismic grid that traverse our entire block. And the blue leads that we see are where we're going to focus that 3D. And as an example, that blob down to the bottom left is called the Akako lead. We think that could contain upwards of 11 million barrels. So that's certainly going to be a very early focus of our 3D seismic shoot. The upper photograph is our existing pad at RCE. We can fit 3 more wells on that pad. We do have modular production facilities there, as indicated in the photograph at the bottom. Those production facilities can handle upwards of 10,000 barrels of total fluid per day, and they are quite expandable as we proceed through our production growth phase. The wells cost about $2.5 million net. They pay out in 6 to 8 months. They're very economic wells, especially in light of the current Brent pricing environment. This is a 3D map of 2 of the more prolific zones that we encounter on the way down to 10,000 feet at our RCE block. The black line that you see trending to the north-northeast is a very major fault, and we have these compressional structures that are juxtaposed against that fault. The initial well, RCE1, came on at 700 barrels a day. The wells that we're going to drill in the near term come in much higher with much thicker reservoir. They're very low risk wells, upwards of 90% chance of success on both of these zones. The C7A, which is a very prolific producer throughout the basin, as is the top of the Gacheta. So very low risk, basically infill wells that we are drilling from our production pad at RCE. We have a 50% working interest. We are the operator. And the Carrizales Norte prospect, we're very excited about. You can see the production increases that we have indicated with 15% declines. Again, really only budgeting for 360 barrels a day net coming out of these pools. The thin black line trending to the northwest is our block boundary. The thick black line is the fault that we're pursuing. The Carrizales field complex to the south, as I mentioned, has produced just under 9 million barrels, peaking at 7,500 barrels a day. The discovery well, which is only 1.5 kilometers away from our block boundary, came on at 2,500 barrels a day. So these is a very prolific trend. CNC Energia drilled this field up in the 2010 timeframe and ultimately sold the asset for $500 million. So we're very excited with this prospect. Again, we have 3 zones on the way down to 10,000 feet. We are higher and thicker than what was encountered in the Carrizales field. So we're very excited to get on, build the drilling pad and get these wells drilled. So here's our Santa Isabel block where we are 100% working interest. We're currently producing about 130 barrels a day. This is in the middle Magdalena Basin. In the upper left, you can see the yellow triangle that is our existing block where we have 3 producing wells. And the green blob you see is an oil accumulation that we believe exists on our block and extends on to now relinquished block. We have applied to the energy regulator, ANH, in Bogota to extend our block to encompass that oil accumulation. We're forecasting no additional production out of here. It's a bit of a free option. And we're going to pursue that block extension opportunity now aggressively as we can demonstrate financial capability and capacity. Again, we have production facilities in place and we can add production very quickly. These wells are much shallower, down to 3,000 feet, much cheaper to drill and pay out in 1 to 2 months. So it's a very prolific area. The big field to the south, the Accordionero field, is producing about 16,000 barrels a day and is Gran Tierra's flagship production base. Gran Tierra is a Canadian domiciled company that's been active in Colombia for the last 15 years. We have an exclusive 3D seismic survey over our block and where we think the pool extension is going to take place. And we commissioned an independent study by Gaffney Klein to come up with what their estimate would be on the development phase of the Santa Isabel block. The map to the bottom left shows where we think we could drill upwards of 20 development wells up against these fault trends that are displayed by the thick black lines. The yellow hachured oblong blob to the southwest of our pool is where we are currently producing 3 wells. And those 3 wells to date have produced about 650,000 barrels in a cumulative basis, which is far more than we would expect, which indicates to us that this oil accumulation is much bigger. And in fact, we have an oil column that has not tested water yet that is 150 feet thick. So there's upwards of 20 development wells we could drill at Santa Isabel and having production peak at about 4,000 barrels a day. And this is an independent study done by a very well-respected consultancy. Again, this is a free option. We're not forecasting any production growth out of here until we secure the block extension that I've mentioned a couple of times. This slide highlights our Canadian Montney asset. The Montney is a formation within the Triassic age. The yellow squares are mineral rights holding in Alberta, Canada. So we have approximately 36 square miles of mineral rights on this Montney play, which is the most sought after oil and gas play currently in Western Canada. There were 2 wells drilled on this play by a predecessor company that we took over. These wells tested very significant rates. The West Pepper 6 of 26 well produced at 7.5 million cubic feet a day at almost 2,000 pounds per square inch pressure. The East Pepper well was a shorter horizontal that is capable of about 3.5 million cubic feet a day. The thin red lines are the pipeline infrastructure that we're going to deliver into. We're currently about to embark on production of that 600-meter pipeline tie-in. That's costing us about $1.4 million. It's going to pay out very quickly when we bring that well on at 5.5 million cubic feet a day, or upwards of 1,000 barrels a day. So that is where our near-term production growth is going to take place. At those kind of rates, we'll be cash flowing $500,000 a month of cash flow moving forward. The East Pepper well, we are also going to be tying in, very economic at today's gas prices in Western Canada that are pushing $6 a thousand cubic feet. So there is a need for gas. There's much demand for gas in Alberta and British Columbia, and we're exporting the most amount of gas to the United States that we ever have. So it is a very valuable asset for us. The royalty rates that we enjoy on this production are approximately 12%, so our netbacks are very strong. And we have a competent persons report shows gas initially in place of about 1.8 TCF. This is a very valuable asset for us. Turning these two wells on provides optionality for us. We can then seek industry appetite to see if there's a farm-in that could be done. These are very expensive wells at $8 million. As well, we would entertain offers in monetizing this asset, but bringing that production on provides proven developed producing reserves. It attracts attention. The production history should be very strong. So this is a very solid economic move. Any cash that we enjoy coming out of this asset, either through farm-in or outright sale, we would then dedicate that cash to our Colombian operations, where we have our focus. From a valuation perspective, we're very cheap, very unrecognized. We've been on the AIM exchange for about a week. On the chart on the left, you can see we're valued at $17,000 per flowing barrel, where the average is upwards of $54,000. And from a enterprise value per barrel in the ground perspective, again, we're very cheap. And we expect to get the word out, especially with our near-term production ads. We'll see these valuation metrics increase on the company's behalf in a net perspective. We have analyst coverage from Octus Advisors in the UK. Stéphane Foucault has been around. He's got at 30 cents a share. Daniel Slater at Arden Partners, who are a nomad, has us at 12 cents a share. He's focused only on PDP volumes at the moment, but certainly recognizes where the upside is going to come from as we proceed through the drilling phase. So we're well supported by a couple of underwriters in London. And from taking steps to value creation, both historically and in future, we have basically brought this company off of the brink. We have reconstituted the board and the management team. We have reduced G&A from $7 million down to $3 million. We initially had 90 employees. Now we have 24. We have resumed production at RCE and intend to be drilling at RCE and at Carrizales Norte. We disposed of an asset to the Carlyle Group for $12 million in the Llanos 23 block. We have solidified our balance sheet, currently sitting on just under $13 million of cash. We've resumed production at Pardo. We have also brought production on at RCE, and we have been successful in financing and listing on the AIM. We're going to drill 4 to 5 wells each at RCE and Carrizales Norte, and ultimately establish a pivot into low-risk exploration drilling on assets we hold. We're looking to maximize the value of our Canadian assets, while at the same time, we are attempting to extend our block at Pardo, which is a bit of a free option. So it's been quite a turnaround. We are really going to be the AIM Exchange's focus on Colombia. All of this underpinned by a commitment to ESG best practices. We're excited with this opportunity. This is very low-hanging fruit, very low risk at excellent oil and gas prices onshore Colombia. So that is our story. We would certainly entertain any questions.
That's great. Thank you very much indeed, Marshall, for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while this company take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we'll email you when that's ready for your review. I'd also like to remind you that your feedback is important to the company, and after this meeting has ended, we'll redirect you for the opportunity to provide your feedback in order that the company can better understand your expectations. Marshall, Gage, I think you're back with us. Can you hear us okay, sir?
Yes, I
Loud
can.
and clear,
Can you
over.
hear me?
That's perfect. Thank you, Gage. Good to have you back. So we had a number of questions submitted by investors ahead of the event, and I wanted, if I may, to start off the Q&A with those. The first question reads as follows. What experience does the board and management have operating assets in Colombia? When new management took over in April 2020, what attracted you to this opportunity?
Well, Colombia is a very prolific oil and gas jurisdiction. It's known for its pro-business background. We've got significant history on management and board operating in Colombia for the past 15 years, successfully, I might add. Canacol is a significant owner, and we represent a spin-off of their oil assets when they pivoted to natural gas production. And their oil assets are highly valued in the right neighborhood with the right address, very low risk. And it's light crude that comes out quickly with no associated solution gas, which again keeps us on side with respect to our operating practices and ESG. Next question.
Next question reads as follows. What was the rationale for the dual listing?
Well, that's a very good question. So we were listed on a Canadian exchange, the TSXV. There was really no historical support. The primary reason we listed on the AIM exchange is UK investors have a much more forward-looking perspective in foreign jurisdictions, whereas the TSXV right now really has pivoted away from oil and gas-centric investing, and it is very difficult raising equity in the Canadian markets for oil and gas players at the moment. There's really been no equity deals done within the energy space within the last 24 months in Canada. So we opted to go to a much more forward-looking exchange in the AIM exchange, and we have succeeded in this financing where it would have been impossible on the Canadian exchange. But now there's additional focus being paid to the company, and we're looking at deploying that cash effectively, economically, and expeditiously.
That's great. Thank you very much indeed, Marshall. Just turning around to M&A, really, how much potential is there for M&A was one of the questions that was submitted.
A very good question. So there are numerous operators in Colombia, some of which are distressed with balance sheets. Some of them are rather big companies and are looking to decant assets to get their balance sheets on side. We are very active in engaging the oil and gas community onshore Colombia in Bogota. So we're well connected in that respect. We wouldn't hesitate to pick up additional production and drilling prospects over the next 24 months. We'll be very active on the M&A phase. In fact, we're looking at a particular deal that was presented to us just this week. So there is multiple opportunities for M&A activity in Colombia. And from an M&A perspective at the same time, we would always entertain mergers and acquisitions of the company if it made sense for our shareholder base.
Thanks very much indeed, Marshall. Next question reads as follows. Will you pay a dividend?
So in the growth phase of this company, we have a vision of getting this company upwards of 10,000 barrels a day. When we achieve the 10,000 barrel a day mark, we would certainly look at issuing a dividend. As it stands now, we're going to be using all of our cash proceeds to exploit the low risk opportunities that I presented to you today. So in the near term, no. In the medium term, yes.
That's Great. Thank you very much indeed. Turning to the next question, how are hydrocarbons priced onshore Colombia?
Again, a good question. So we enjoy reference pricing off of Brent. And Brent, as we know, is very strong in and around the $80 range per barrel. The pricing that we receive at the field is called the Vasconia differential, which is a $2 to $5 differential off Brent pricing. Historically, it's hovered more around $2 where it is today. So very strong pricing onshore Colombia using the Brent Vasconia reference.
That's great. Thank you very much indeed. Will you eventually divest entirely from onshore Canada?
Yeah, we would, if the right deal came along, we would certainly divest on the Canadian asset. As I mentioned, the Montney play is the most sought after, and it is almost impossible to put a land base together like we have with 36 square miles of mineral rights in the Montney. As I mentioned, those wells are expensive. They're long-reach horizontals that require multi-stage fracs, but the gas comes out very quickly, and ultimately there would be liquids recovery as well. So it's attracting attention. It will attract more attention as we put these wells on production. But yes, we would look at deploying the cash received either from cash flow or an outright sale or farm out back into our Colombian prospects.
That's great. Thank you very much. We've got three more.
I would add as well that it's almost like a free option because a predecessor company drilled these two wells. They tested them and they were standing idle and not tied in. So this is an expenditure of about $16 to $18 million that we're taking advantage of by investing $1.4 million for the West Pepper well and about $1.5 for the East Pepper well. So we're getting the benefit of those assets that was never realized in the company beforehand.
That's great. Thank you, Gage, and sorry to cut across. Next question. We've got three more of these pre-submitted questions, and then perhaps we can look at some of the live questions. What is your overarching strategic objective for the company for the next 12 to 24 months?
Production adds are our focus. The cash flow forecast, as I mentioned, is very conservative at 360 barrels a day net. These wells come on much stronger than that. So our focus is to get to the 3,000 barrel a day threshold as quickly as possible without being overly aggressive. But the economics of drilling these wells is very robust in the current pricing environment. Our netbacks on this crude exceed $55 per barrel after operating costs and G&A. So that 3,000 barrel a day threshold is very important to us. On the AIM exchange, we would likely be the only foreign onshore operator in South America that is actually producing and cash flowing. So we're very excited with the perspectiveness that we've got in front of us.
Thank you very much indeed, Marshall. And I guess finally, what could your near-term production growth profile look like?
It's a very solid ascent, adding production on a monthly basis. So as mentioned, these wells take about 2 weeks to drill, another 2 weeks to production test and get on stream. So production adds into our existing facility are very straightforward at 360 barrels a day per well. And we'll get to 3,000 barrels a day in 18 months.
Great. Thank you very much indeed. Well, that takes care of the pre-submitted questions. So thank you to those investors that took the time to submit those. Max, I don't know whether if I could hand back to you to have a look through the live Q&A, and if I could ask you to read out the questions and I guess where appropriate, give those responses, and then I'll pick up from you at the end.
Sure, I'm happy to do that. So there was a question from Michael with respect to cash in relation to market cap. So to quote, you said you have 12 million British pounds in cash, producing assets and a market cap of just 14 million. What am I missing? And so I guess, Michael, in response to that, yeah, right now after the financing, we have approximately 9.1 million British pounds in cash. And the market cap, just using our basic shares, is around 14.5 million. So we're trading, just slightly above the cash amount, if you will. So we are undervalued based on obviously our assets that Marshall discussed. cash flow, and importantly, in relation to our peers. Of course, we've just gone public on the AIM, as Marshall said, just over a week ago. We were listed on the TSX for some time, and we hope to materially change, that valuation paradigm as we execute in the field. So hopefully that answers the question. There was another question that came in from David. What probability would you put on getting the Pardo extension? So, Marshall, I hate to put you on the spot, but if we were to handicap the probability of that happening in the next, let's say 12 months, what do we think that is, or is there a better way to answer that question?
Well, our focus will certainly be on aggressively pursuing the block extension. We've had an application in front of the energy regulator now for some time. The fact that we can show financial capacity really strengthens our case in going to the ANH and getting that block extended. There's certainly precedent for it within the basin, within all the basins of Columbia. So we're very confident inside of the next 12 months we'll secure that block extension and initiate drilling on the Pardo block.
Okay, and there was another question, Marshall, from David. Again, David says, looking at read-through from other transactions, what value would you aspire for your Canadian assets once those 2 wells are brought on production?
So in aggregate, those 2 wells will be producing through 2022 close to 1,000 barrels a day after declines had set in. And production metrics on Montney acquisitions in Canada are upwards of $25,000 per flowing BOE. So that adds quite an exciting valuation to our assets, taking into account that these wells are upwards of $8 million to drill. So $10 to $20 million would be, I think, a very attractive transaction for us on the Montney asset. If this thing was fully developed to its potential with a 40-well drilling program, you'd be looking at a TCF of gas reserves. Next question.
That's great. There was another question with respect to what do management own in terms of shares, and the cumulative ownership is between the management team on the call. Of course, we've got other management shareholders that are not on the call, but the top executives that are on this call own approximately 6.5% of the shares outstanding.
That's great. Thank you very much indeed, Max. And I think you've taken care of all the questions that have come through. If any more questions do come through, obviously we'll make these available to you for your review afterwards. Marshall, I know it's early in the morning with you. I know that feedback is important to you as well. We'll shortly redirect investors to give you their thoughts and expectations, but perhaps before doing so, I could just ask you for a few closing comments to wrap up with.
Thank you for that.
Just before you go ahead, Marshall, the other thing I would add to Max's answer is management bought those shares at the same price as the placing on the AIM placing. So while we own 6% of the 6.25% of the shares, we did so at the same price that investors in the UK did. So sorry, go ahead, Marshall.
And that was a $1.4 million investment. So we've got a very solid foundation now from a production base, from a land holding base onshore Columbia. We're very excited to take this company to the next phase. The drilling phase, we're tying in production very quickly here within the next month. That's going to provide some traction on the share price. When we do get that well tied in, we're going to be doing much more aggressive marketing on promoting the stock. We'll be in London probably for a week to 10 days to meet with all existing and new shareholders and future shareholders. So we'll be very active in promoting the stock and getting traction on that share price to a much more realistic valuation. The prospects that we're going to pursue in the near term are very low risk, and adding production conservatively at 360 barrels a day net, when these wells can produce upwards of 2,000 barrels a day. So we're very excited with that platform. And then as we proceed through our development drilling program, we're going to start focusing on exploration assets. We feel that we've got 10,000 barrels a day of potential on our existing land holdings onshore Colombia. So it's a very exciting growth phase for us. And the AIM exchange, as I've mentioned, is very forward-looking. We look forward to being treated very positively on the AIM exchange. So it's an exciting growth engine for us. We're committed. We are parallel to all our investors, and we look forward to reporting good news in the very near future. Thank you for your time today. This is a very exciting platform for us to be involved in.
That's great, Marshall. Thank you very much, and to Gage, Joe, and to Max for your time and for updating investors this afternoon. Can I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Arrow Exploration, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon and good morning to you guys in the US.